So what happened in the Winthrop Center, we have been going through extensively about the decision making. At the end of the day, you probably want to ask, how is this a successful project? And if you recall that we map on the blackboard about many stakeholder or people went into that. So I think I would encourage you to think about to evaluate the success of a decision or not from the different stakeholder perspective. So let's first take a look at the developer. Winthrop Center has been decided to go to construction between 2016 to 2018. So let's see where the market is at the 2019. So the biggest deal in 2019 in the same submarket, Boston CBD area, is 100 Summer Street. That building is a single glazed curtain wall, very brown building, and that was transacted at a 4 cap. So this is the market signal saying that in the asset market, the buyer or the market isn't really considering any green premium, like in the transaction, unfortunately. And State Street in 2019 is one of the anchor tenants Winthrop Center is trying to gain over with its competitor, 1 Congress Street. However, State Street decided to go over to 1 Congress instead of Winthrop. So I asked the head of global real estate, like why they decided to go for the 1 Congress Street, which is a less sustainable building than Winthrop. And it turns out that what drives decision is like one, the floor plate. The Winthrop is a T-shaped floor plate, while this is an oval. In terms of usability of a floor plate, this is a much better floor plate. And another disadvantage of the Winthrop is that it's predominantly a luxury condo building. So when in the design, the office part is kind of secondary. So when you're an office tenant, you feel, the parking, the entrance is not as grandeur as an all office building. So that makes the tenants really not comparing to that. And last but not least is really the rent. At the time, Winthrop decided not to give up its rent premium because once you sign the lease, it's 10, 15 years, it's going to hurt your performance significantly. So they are not ready to give up all the hard work and all the risks that they have been undertaking. As you know, you should be compensated for the risk, but unfortunately they lost that, and which means that the building is going to sit empty when it is finished, and it's going to be a cash drain, unfortunately. So that's, and also in 2020, in January, when Winthrop Center is about to close the debt from HSBC, a couple weeks later, like almost in days, the COVID hit, and the loan syndication market is non-existing. So HSBC pulled off their deal, and Winthrop Center is experienced a near death that has been paused construction for almost 3 months.
You said the office was going to sit vacant, but the case had said that there were over 60% pre-leased prior to construction. What happened?
Prior to construction is 0%, if you read the case. The case says it's 0.
It said both. In another section, it said it was over 58%.
Oh, are you talking about the Winthrop Center?
Yeah.
No, it's not.
0%?
Yeah, it's a 0% pre-lease, yeah. So after the construction, they start to lease the building, and the State Street is one of the key ideal tenant they try to win over. But unfortunately, they lost it because and when the State Street, I recall Cassie told me, State Street comes to the passive house. They have never heard about passive house, and they say, what is passive house? Like, first of all, and then it sounds like we don't want to be a guinea pig. But then wait a minute, right? It's not a guinea pig. It's a way much better impactful building. But unfortunately, there's a lot of education and knowledge and information asymmetry in the market where the market, fails to pay for this green premium. But later they pull back. They find a Kuwait-based sovereignty fund to finance the $700 million loan. So that project was get back to on track and is about to, I think this month, they are finally getting their certificate of occupancy. And talking about the risk, there's one project we cannot skip is the Cornell Tech. That project is very instrumental in the decision-making of the Winthrop Center to de-risk the whole bet of 1.3 million bet. And at the time, 2018, this is world biggest passive house, 250,000 square feet. And when you look at the story behind Cornell Tech, Hudson, it's a partnership between Hudson and Cornell and between the university, right? So I think right now everyone should get it that passive house is really, according to the president, is a real deal comparing to LEED. Like a lot of LEED, you can get away with high point, but not really means your building is much better. But Hudson has been pulled back the last minute of a market rate project before the Cornell Tech. And the reason, according to David Kramer, is that the risk-return equation when you are doing things for the first time. That's why we blinked at the last second, because we knew we'd be paying a premium in construction costs and didn't think we'd be able to get higher rents, and we weren't sure we're going to make up through the savings in the operating costs because of a lot of uncertainty. So Cornell Tech, the reason why the Cornell Tech behind that is that because Cornell took a significant equity stake in the building. So to de-risk the developer risk, and was be able to keep rents affordable for students. So while the knowledge progress, when you look at the history of...
Do you mind if I ask a question on the previous slide, which says, a lot of LEED is not that impactful. This is something that I'm actually very interested in. So is there a difference between, LEED certified, LEED gold, in terms of rent levels? Is there a big difference, would you say?
Yeah.
That's true. If you look at the first lecture of the green buildings, many researchers already published papers. There's a differential. Differential is a price premium. The platinum will be the highest.
Yeah, I recall that there should be empirical study on that. Yeah. So when you look at the idea, the green building movement, like starting in 2000, like the early adopters and the early movers of this any sustainability idea is always the corporate real estate and the MUSH segment. By MUSH, we mean municipal government, universities, schools, and hospitals, right? When you look at this diagram, the private developer, right? They started very, very tiny in the market penetration. Why? It's because of the risk. And so when the information start to propagate, and then in the economics session, we talk about when the market works and when the market fail. So these are really, this segment are the people who is going to take the risk and not underwrite the premium to promote the sustainability. And then the public sector will follow. Now, passive house in 2020, Steve Winter, the passive house specialist who worked on the Cornell Tech as well as the Winthrop, has did a study when the data comes in, because at that time, after four years, there's more and more people picking up this idea, right? So they studied, what is really the cost premium? It turns out the premium ranges from 1% to 8%, and when you look at all these higher cost premium, you notice that there is very inexperienced builder. So which means when you do things for the first time, there is a cost premium involved, which is where the knowledge gap, like we say the information symmetric, will really affect even your cost premium. I believe this building is Winthrop, and the cost premium end up being 1%, right? Because we are talking about the top-notch developer who has really perfect execution, and they learn really fast working with the best consulting team in the world, and they work with the construction team and who's willing to take the risk and align the interest with them. So who do you think will be happy in the people's map? Well, Winthrop Center, I don't think it's the final chapter yet, right? As people say, this building may make money second time around, but for this time, maybe not so much. I don't think they meet their performer REIT premium just because the market reality, but it may catch up in the second round. But who do you think will be happier than the developer in the stakeholder map?
The tenants will.
The tenants, yeah, the tenants will definitely pay less and get a very performance building. Who else?
The city?
Yeah, the city, that's right. So I would say one of the biggest winners is really the city of Boston or even Massachusetts. So Berto 2.0, like the building, city of Boston start to push very aggressively on the climate action. And as of 2020, Massachusetts has adopted one of the most stringent US building energy code, which is called envelope backstop. So which this building code tells us is that they are actually introducing the elements of passive house in the building code without calling it passive house. So what the Winthrop Center case, when it goes through the MIPA process, right, because they have to go through this thousands pages MIPA process, the MIPA is the Massachusetts EPA, right? They learned that, oh, actually you can achieve a vision ratio of 45 to 50%, and doing a triple glazed window, it's still workable. So then they get educated, see, oh, if they can do that, why not other developer? So, and then that provision, from that provision, the developer have to do triple glazed window, right? There's no, because the regulation organized require you to do so. And in 2021, like two years before, Boston is now home to 3 of the largest passive house projects in the United States. Winthrop Center, Bunker Hill redevelopment is a 2,700 units housing, including both market rate and affordable housing, right? And then Northland Newton development in Newton, that's 800 units in housing. And Siqi and I visited the Northland Newton development, so we asked the developer, oh, how come you decided to push such a high level of sustainability, which is passive house? And the developer told us they originally are proposing a lead planting because they think it's already great enough, right? They thought the city would be happy. Surprisingly, the city of Newton, because they hang out with city of Boston people, they come back, say, hey, we heard there's something called passive house, and there's a huge building in city of Boston, and we heard that they are 80% more energy efficient than the lead, and it's like way more, like it's a real deal, right? So the developer get back to do their homework and come out with a passive house proposal, and that project is currently under public hearing. And then NGOs will start to create, grants to prove passive house for the massive adoption. So what we learn from how the sustainability propagate is that usually there's an idea generating from studies in the scientist or the design community, right? They pushing the frontier of the innovation. Then there's a pilot, usually in the corporate real estate or the MUSH segment, which is that they take less development risk. Then there will be followers in the wider community, like commercial real estate, like a speculative development. And then there's a true game changer. What Siqi will mention, right, in economics is that when the regulation truly come, then it's the market majority. That's really the scale up. So if you look at any the idea of the sustainability, always started with something, risk, and then people get to do it, then the knowledge, the risk has been getting better, then with the information started to propagate, the rent premium, like the market start to react to that and then start to reward such a building performance, and then it will become the new norm, right? Then we move on to the next project. And for the passive house, another reason I want to mention that is that in the Massachusetts stretch code, which is going to go effect, I think July this year, what is the net zero stretch code? Passive house is going to be one of the optimum pathway towards the net zero. Yeah, so right now, developer is also wondering, like looking into the passive house, understanding cost premium, and to see how they can help them achieve the net zero, because that's where the industry is moving towards. Okay, so let's move to the 425 Park Avenue. Can you help me to change? Oh, yeah, sorry.
About the research slides.
Oh.
Okay.
Which slide? Yeah.
Different passive building has a different cost. So what's the most important conditional design to the tenant and the market feedback? Top three.
So your question is that the cost premium seems vary a lot, 1 to 5%. So are you saying why the market?
What's the most important design to?
Or design element. So
tenant and the market from the feedback.
Okay. So I don't think the tenants and the market are there yet. There are still a lot of these projects is still in construction, so they are still trying to understand the cost, less about the benefits part yet. So for the cost, I think the biggest component of cost goes to the envelope, right? Your triple glazed window, and then you will do very special treatment of the thermal bridge of your envelope. So I think that's where the biggest the money will goes to. But I don't know about the tenants part yet, which maybe we'll have more information next year, hopefully, when the tenants move into Winthrop. Aria?
What about the condo side, the LEED Platinum, is that affected at all? What is the takeaway from that?
They decided to go LEED Gold for the condo part. So the condo part, because they sell it, they don't hold it. So the Berto 2.0 is less a headache to the landlord than to the condo association. But they are going to face fines because they didn't go for electrification. Yeah.
Follow up that question, because as a developer, we also hope to pay less money and get positive feedback from the tenant. So if passive building has a different design, maybe we can give the important conditional design to the tenant and get less money, less cost, and high revenue.
Yeah. Yeah, I'm sure that the community will start to propagate, and eventually, I think, will further reduce the cost. You know, when the vendor they comes in and they feel more comfortable, and then, like eventually, thanks to the regulation, everyone is going to do it, right? So it's no longer a debate anymore. We're just going to do it. Okay, let's move to the 425 Park Avenue. So this building, again, is 10 years ago, in the fall 2012. The case is about, in the fall 2012, L&L developer, who is contemplating the design of their next project, which is in 425 Park Avenue. It's an office, predominantly office building with a little bit retail at the bottom. So Leasing, the LP, sorry, not LP, I think he's the GP. The GP developer, in the case, he had a hunch that the next important trend in the urban office leases would revolve around health and wellness. So he's in a very influential decision to bet, it's another bet, about this $1 billion office project, and to see how they can design the vision of the project. Can someone give us some high-level summary about the project character? Can you put on your name card? Does everyone have your name card? Mamu, can you give us a project character?
So the 670 rentable square feet.
Oh, what's the square feet?
670,000.
670,000? Yeah, square feet.
So that's for office space. Then for retail space, it's 18,000.
Yeah. 18,000 retail. Yeah.
And there's a 52 car parking garage.
Okay. Why is LLL decided to develop the site in 2012? Andy?
The property was cash flow negative at the time. There was, they had a partnership with Lehman, I believe, and they had a land lease. site. And then the financial crisis hit, and their partner became insolvent. They ultimately bought them out and decided to move forward with their original plan, so it wasn't such a cash drain in their investment.
Yeah, that's right. So it's a huge cash drain. So they are very motivated to move fast. What else? What else about the situation? David?
The city zoning regulation changed, and they needed to retain 25% of their base design from a local building.
So how do you feel about this? Retain 25% of the building. Yeah. So the situation is that if they don't retain 25% of the building, they cannot achieve the highest floor square footage because of the zoning change. So in order to maximize the divide, and the investment is no longer attainable, right? So in order to keep the current economics work, they have to keep 25% of the existing building. How do you feel about that? How do you feel about keeping 25% of the existing? Bill?
It's really difficult to do that, and it's expensive. Like architecturally, it's hard to do that, and structurally, and then it's just going to add to your costs.
How much cost? Extremely difficult, right, to keep a 25% of.
I'm not sure. I'm looking at my notes. I don't remember how much extra it's going to cost, but it was going to be significant.
Significant, yeah. So the cost premium is 8%. So let's look at the market. So to summarize the basic project character. So it's a ground lease, major cash drain. Then there's the financing uncertainty. Right, the Lehman Brothers, and although they are still honoring the loan, but you don't know. And the zoning, they have to keep 25% of the structure. It's really extremely difficult for any engineer or designer for that. So let's take a look at the market. How is the market in the New York office market? How is the market like? What's the market situation? Sorry.
They cited like One World Trade Center, which has 3 million square feet of office space, and then Hudson Yards was also under development at the time, which was the live, work, play complex.
So you're saying there's 2 development at the same time? One is the...
Yeah, both like the focus on amenities.
Okay, sorry. Can I open another? Can you help me open another? I think I got... I was going to pull up the map to look at the situation of the market. So Ariel, sorry, can you... Sorry, can I get this? Oh. So can you get this? What about? Oh, here, yeah. Can you come over? Yeah. So let's take a look at the market. So how is the market like? How about the location? How do you feel the location about the project? Ariel, you say there's one development going on, which is Hudson Yard, right? And Ern, do you have anything to add? I see you raise your hand earlier.
I was going to say the same. There's a lot of competition is going on, and that is why these two alone already flooded the market.
So how do you feel about the location comparing to their competitors? Becky?
Yeah, so the location it's not as prime as the financial center or the other sectors. And the case also mentioned that in that region, the rent price is not, the average rent price is not as high as the other as well. So they have to be conscious about raising the rent too high.
Do we have anyone from New York City? knows about the New York City office market? So if we compare these three locations, the difference is that, so in the Winthrop Center, we're talking about, it's the same sublocation, but this is not the same sublocation. So location-wise, ground zero is in the financial district, right? Is in the downtown Wall Street. So after 2009-11, a lot of the financial company, they all move up to Midtown. So among these three locations, the ground zero actually is the cheapest. Like downtown is the cheapest location. Hudson Yard, it's really not really meant to be an office cluster. So it's a new development. So how big is Hudson Yard? Does anyone look into that? So Hudson Yard. It's about 10 million square feet. The ground zero, the One World Trade Center, do you know how big is that? One Trade Center is about 3 million. So in terms of location, it's arguably one of the best locations in Midtown office, because Midtown is usually much higher than the downtown. That's Park Avenue, very prominent address, closer to the Central Park and at the plot of the Plaza District. So location-wise, this project has a very obvious advantage than its competitors. And the competitors, so this is a New York office market, 670,000 square feet isn't really that big of deal, right? So especially when we look at Hudson, and Hudson is almost leased up. When you check CoStar today, it's almost leased up. It's 10 million. So we are talking about different magnitude of the market than Boston market, right? So the Hudson Yard, originally, a lot of people has doubt about it, but it turns out working very well because many financial institutes, they have been scattered around in the Midtown location. And Hudson Yard, they will be able to sign very big lease from big company because they feel that's their last chance to move into a Class A building. They can consolidate their company. Rent-wise, Hudson Yard is around 80 to 120 range, while ground zero is less, about $70 per square feet. And Park Avenue is definitely towards the end of the market. Okay, so this is the supply side. How about the demand side? The office market. What are the people? What are the trend in the urban office leases?
Towards Class A.
Sorry, your name is?
Keep on towards Class A because of work at home movement.
Sorry, I need to.
Keep on.
Oh, keep on. Yeah. So
there's a movement towards Class A type buildings because of work at home environment.
Oh, it's 2012. We're talking about 2012. So there's not. So.
Okay, so that's a long time ago.
Yeah, so that's a long time ago.
So never mind.
So yeah, so the decision was made 10 years ago, and the trend is actually not work from home, but they are moving towards health and wellness, and that's where the Cognex study comes out, which inspired the vision.
At that time, it was trendful, the green buildings, because of this sick building syndrome that was going up. It was being calculated and very looked into by government regulations and landlords across the state. So people were actually investing quite a lot in how they were going to improve their buildings into a more attractive place, both to tenants and landlords. And also taking into account that 2012 was basically 3 years after the GFC. So there was actually a lot of demand of movement of rising economy, rising companies, companies going back into business. that were previously probably broke or not doing very well during the last couple of years.
Leah?
And specific to this building, they were trying to attract like elite companies that need top talent, so that is
Yeah, that's right. So the vision, what L&L development has, is to build the healthiest building of the in the New York City for the reason Carlo and Leah mentioned. So, do you think they are well equipped to do this? How do you think how do you think that their capability is this opportunity? Do you think fit their investment philosophy? Tamar?
I think they want to be, so that's a good first step.
Can they do it? Do you think? What do you think? You don't know. Who knows? What did the case say about the capability of this developer? What's your expertise? Clement?
So I think they have experience in building conventional green buildings, but they have no experience yet with the healthy green buildings. There are also no comparable buildings that have like the WELL certificate yet.
Yeah.
But therefore they are sort of confident that they could do it and set a landmark.
So there is some uncertainty, right? It's something new. So the product vision, the healthiest building in the New York, we just mentioned there's a science and then there's a regulation coming about the sick building syndrome. And from the market demand side, the demand side is the elite companies. People would look for health and well-being. That's kind of the hunch of the Levinson, right? From the competition side, yes, there is a hot competition, but I would argue that Park Avenue still have one of the best location. At the end of the day, it's still the location, the main drive change. So it's a question that do they really need to go that healthy building because it's in Park Avenue. 6,700 square feet in office in New York is not really that of a big deal. So it seems that they can handle probably. And the capability. So L&L Holding was founded in 2000. So they have a decades of brokerage and the investment side of commercial real estate, especially in office. So they have a very experience in understanding. So that, I believe, they really understand office tenants' needs besides the trend thing because they are the one talking to the tenants on a daily basis. And they also have access to capital for the long-term investor. So it seems that they are well equipped for that. Although at the same time, it's a new concept, it's the science breakthrough, they are not sure about the technology per se. So let's look at the options, what they have, and do the cost benefits analysis. Now, Levinson will have to decide how much they are going to invest into making the building extra healthy as a landlord. What are the options they have? When you look at the performer, what are the items they are comparing against? What are the options, Chris?
Premium ventilation and filtration.
Okay, so ventilation and filtration. And filtration. And this is related to which aspect of the building? The ventilation and the filtration? It's mainly the indoor air quality. I mean, the performance is the indoor air quality. And what's the other option? Yeah, well certificate. What's their alternative if they don't do this? What's their alternative? Derek?
I think they were also considering a CDC certification for healthy buildings that was different than the WELL certificate that had less stringent requirements and lower cost of.
What's the name of that? It's the Fitwell, right? this is probably a cheaper option than well. What's their alternative? Like if they don't do this, what's their alternative? Yeah, they can do a green building. If you look at the lead points, they actually have 20 points in RAQ. So a lot of time people can argue green building is also healthy building, or actually included. What are the benefits of the healthy building? And what are the costs? How do you compare that? Yun?
The benefits of the healthy building.
Yeah, these different options they have.
So ventilation and filtration, it's basically a performance measure. So yes, you will get better air quality compared to outside air.
Yeah, better air quality.
The cost is obviously it takes more energy
Yeah.
to run this because you're creating more friction. Yeah, like resistance.
What's the cost?
I don't know.
In the performa, if you look into the exhibit, if you look into the exhibit 8 or exhibit 9, what's the cost of the of this item? So this is the no, right? So what is the cost for adding those? Jason?
Well, in Exhibit 9, it's a $3.5 million operating cost increase.
Yeah, 3.9 operating cost. How about the initial cost? What? What's the unit? 12.3 what? Huh? Million, right? Okay. So what's the cost premium in terms of percentage? 12.3 million percentage.
1%.
So we're talking about 1% premium. Actually, this is combined, right? This is combined. And how do you feel about this? 1% premium, Andy?
I said it in the discussion post that this seemed optimistic because in the case itself, the projections were 5 times this cost premium. Said anywhere from 3% to 6% just for the added ventilation, and then for the well certification, an additional 1 to 3%, I believe it was. So, you know, this seems like a very optimistic scenario that there's only 1% cost increase, but an over 10% revenue increase.
Mm-hmm. Yeah, so the cost side, if you add on the well and also operation cost, as well as the commission cost, we are arriving somewhere between 2 to 6% cost premium. How do you feel about the cost premium? If you were L&L, do you think that's a good investment? Like in the case it wrote 5% rent premium. Do you want to, if it were you, will you underwrite that rent premium?
My concern was that in 2012, this was the very beginning where people were even discussing indoor air quality and the potential benefits. So I thought that given the location, the building was already at a premium.
Mm-hmm.
I wasn't sure in 2012 if the added cost at that time
Mm-hmm.
would actually yield a 10% plus rent premium.
Mm-hmm.
The building already had a lot going for it based on its location and the stunning architecture with the 3-story function space that they have in the middle and on the lobby. It was difficult for me to buy into this pro forma that seemed like it was overly optimistic versus the numbers were given in the case.
Overly optimistic. Carlo?
I think there's also a huge part of this that has to be taken into account in the operating expenditures. So L&L, they were not experiencing this specific type of building, so they were assuming that they had some like OPEX premium calculated as well. That was actually high. If you look into the pro forma,
Yeah.
it goes from 40 to 43 million, which
Yeah.
is around like 8-9% of augmentation in OPEX, and this is only a projection, forecast. So you won't actually know what you're going to find at the moment you're actually operating this, for example, this ventilation and filtration equipment that it's rather
What's the equipment exactly are we talking about?
innovating. What?
What's the equipment we are actually talking about? You say the ventilation and the filtration. What's the technology, if you recall in the case? What did it say? What's it called? MERV 15. What's the industry standard? Yeah, so Carlos, you are talking about this MERV. It's a filtration. It's cutting edge, right? So you're saying there's a lot of uncertainty about the operation cost. Assumption seems, may not be that convincing. Sorry, your name is? Okay, Marco, yeah.
I think one point they didn't mention is that in the pro forma, they add all the operation costs to the tenant, not anything else. So that's another group. So for the tenant, they got the operation expense and as well as about 8% rent premium.
Yeah.
That could be a lot.
Yeah.
That part, I think, they may not accept that.
So there's a tenant's part, right? You are not sure that they are going to pay more and then actually spend more. That doesn't seem a good deal for the tenants. Ariel?
They didn't really mention vacancy rate, but they did mention that there was like a $1 million per year commissioning of their mechanical and ventilation system, which would be a cost to them regardless if they had, so they have less of a buffer in terms of vacancy.
I don't think they're going to have it regardless whether they'll have the healthy building. I think that's an extra. If they go for healthy, yeah, I think that's included in the 2 and 6 premium if you add on everything. So who else? Like, do you have anything like different from Andy? Because Andy think that they already have a premium location, and in terms of the size, it doesn't seem to be a hard sell location. It's going to be a very easy sell, so it doesn't seem to make sense for that. Who do you think it makes sense to invest in the healthy building? I remember quite a few students would say it makes sense. Celine?
So basically, from the tenant-wise, because most of the tenants will be some other firms like providing consulting service or legal service. So for these companies, the performance of the employees will be a good count for their revenues and for company-wise. So I think it's kind of important to address that a healthier indoor environment will enhance the working environment for these employees, to increase the values for the tenants.
So I think we are saying like the science seems to pretty rigorous, right? It's like they have already proved, although it's in a lab, but it's proved that the performance and the L&L, if they are kind of the one talking to the tenants on a daily basis, they should know the market really, really well. So they are the one believing that this is going to sell. How about the rent premium? How do you feel about this rent premium in this pro forma?
I think it depends on the border, like how can the improvement of the working performance can recoup the rent premium.
Okay, so you say, okay, the story, the science seems nice, right? But then you are still unsure. Derek?
Yeah, I think that it's a pretty compelling argument because, especially given the data that's recently come out, I think it's pretty easy for the tenants to go to the health insurance providers and kind of recoup the rent premium just by negotiating better rates on health insurance. I mean, any additional savings in terms of employee retention or absenteeism is kind of just going to go straight to the bottom line.
So Derek, you think the science is pretty solid, and you are confident that if you go to the tenants, they should buy into that, right?
Well, I think it's good enough to like put it as a point of negotiation with the insurance providers, and I think that they would probably find it to be compelling.
So then how about like because if you think about this, they already have 8% cost premium to build that because the structure difficulty. And for 1% of the premium or 2 to 6%, if we add on into the operation, as well as the well certification. Well is a very expensive certificate, right? So how do you feel about adding this money into green building? Because they originally designed for gold. How about updated to platinum? Because it seems that there's less risk, right? People understand about it, and it actually includes the IAQ. How do you spend like this money onto elsewhere? Bill?
Sorry, part of what we've been talking about like as a theme in this class is the lack of continuous examination with LEED and the fact that it's just a checklist and it's one and done. I think something we haven't talked about here is the continuous commissioning, which I think is huge, to come back every year and ensure that the health benefits are actually continuing rather than just being designed and then let go forever. I think that would really be a huge selling point for a sophisticated tenant who's really caring about the health of their employees to say, hey, we're going to come back and check that all the time. I think that'd be a big selling point.
Yeah, I hear that we mentioned the tenants, the word a lot. Who do you think is the tenants in Park Avenue? Ultra premium, like a hedge fund? Yeah, the Park Street is the banks, is really the financial industry, right? So like you are saying that this commissioning, actually they are very sophisticated. So if we look at this healthy building that Juan shows on his lecture, right? This is the argument where the scientists, after they did a cognitive study, they put this into the balance sheet and arguing that there is a 4 type of value add from the revenue, rent premium, to payroll, rent, utilities, and other expenses, right? So there is some solid number behind that. But then, nevertheless, it's still a lot of assumption. If you look at this reading from Malvin and Chris Meyer, they talk about, this is the performer, they come up with a sample tenants. And the assumption is that if it is a 1,000 employee, it seems like where the Park Avenue, you know, if you look at, they probably look at that size of the company, 1,000 employee, total square footage. They underwrite 4 type of the number for the gain is the total. So what they did is the health insurance reduction, 10%, right, as Derek mentioned. Productivity increase, right? Getting back to the question, your earlier question, how do you actually measure the productivity? Based on the lab study, I think they underwrite about 1.5% about the productivity increase. Then turnover reduction. Why it is important? Because, you know, it's very expensive to hire people, right? Probably 3 months salary, and then absence reduction. So what they calculate is they come out with this IRR huge. If they did 3 scenario sensitive analysis, even look at the lowest scenario, 0.5% productivity increase, you are looking at IRR 298 and MVP 5.6 million. So I want to do, yeah, Xinyuan.
I'm wondering, in 2012, did we have this kind of study in hand? Because I know maybe the WOW has some research data to back the program up, but how to convince the tenants that by, you know, moving your employees into this building to actually have this kind of.
That's a very good point. I don't think they have, but this form, I'm sure that they probably will have this form, but it's not the empirical data. It's assumptions. And in this case, I think it's a corporate real estate.
This is like 2017? I'm assuming they're studying
it's right, yeah, it's after that.
Okay.
Yeah, and even that, it is assumption. It's assumption data. So I want to do a little poll that now I want you to put into the shoes of the tenants. Imagine if you are Citadel or hedge fund that this landlord trying to pitch you to sell you, and they show you this performer, as well as the cognitive study, and they may invite Juan over to give you a lecture about the science building, and I want to do a poll. Is that 3 options? Number 1 is that yes, with no reservation, I believe in the science. B is that yes, with minor reservation, and C is that I highly doubt it, which means I don't buy into it. Raise your hand if you pick A. Yes, with no reservation. What? I think we need to invite Juan back to give you a better lecture on the science. How about B? How about C? Okay, so there's something called the law of the innovation of diffusion. This is the law. So what the law told us is that, so every one of us sits somewhere at a certain time on this scale. What the law told us, the law of innovation of diffusion told us that if you want a success of a mass market success of an idea, you need to achieve at this tipping point, which is about 15 to 18%, and then the system will tip. So if we set all the segments, what we get is that, so 5%, 2.5% of our population are innovators. They are the people called the tech enthusiastic. They are the people who are waiting in the line for hours to get the first iPhone, while you can perfectly get it a week later. Then you have the next segment, 13.5% of the people is called early adopter. So they are also called visionaries, right? So they are usually act on the hunch, right? Which L&L says, oh, there's a hunch. So they are willing to bet $1 billion on the hunch. Well, you don't really have this quantitative, like empirical data to show that. And 34% of our population is called early majority. Those are the programmatic people, right? They make decisions based on something quantifiable, and you have to show me it, right? It's not assumptions, scientific lab study. Another 34%, late majority. 60% is called lagger. Those are conservatists, even more conservative than that. They won't try something new until someone else tried it. They think innovation is the bleeding edge. They don't believe in the cutting edge, right? And then the lagger, finally they have to do it because you don't have any choice. So this half of our population really won't move until the regulation says yes, right? Until that your competition is become new norm, you have to do that. So looking at unfortunately we don't have innovators in this classroom. I think someone of here, 14 of you may become early adopter. I think, so we kind of actually, this sample class actually follow the law of the diffusion of innovation. Jason?
I mean, I just find like the way the question is constructed is like very hypothetical. As a tenant, and your landlord's showing you some technology they want to implement, and it's showing you how they're going to make money off of that, off of you. Like, of course, like you would doubt it as a
But what if they show you the cognitive study?
Well, they'll be like, oh, did you pay for this study?
Actually, it's a peer-reviewed scientific journal. You cannot pay for that.
It's just like the way that it's being presented, that your landlord is the one showing you the study. So it's like,
Then can you think about a better way to educate your tenants if you don't show them the study?
I mean, I know like a lot of firms will try to get an academic institution to back it up and have the large channel of information be through.
What do you mean by back it up?
Party or through an institution.
Yeah, that's understand.
Public documents.
PR, yeah. They can publish some media paper, say, quote, or Harvard study, MIT study, right? Instead of saying, like, I show you this. Bill?
How does this factor in for age? Because I feel like generally as you get older, you tend to be more conservative, and especially with technology. Is this like for everyone in the same age group?
That's an important point. Let's get back to that. So, and that's why it's spread in this document. And so what they think, I think, Jason, what you mentioned is that I believe 9 out of the 10 people will just laugh at it, right? But you may get one person. You only need 1 out of 10 that they trust their gut feeling. They say, oh, you know what? It's actually it's a peer-reviewed journal, right? It's not that you some fluffy consultancy report, which I agree. This part is kind of consultancy report. They're written by consultant people, but this is not, right? But if you tell Siqi is like the scientific journal, right? There's no way you can sway the economist data, right? So in terms of rigorous, I agree. There's a rigorous in the scientific peer-reviewed journal instead of the gray literature. But what informed this project is that all you need to get is this 1% of the 1 people. And what L&L decided to do is that they decided to go all in. What do you think is their game plan? By the way, if you haven't read there's Jeffrey Moore, Crossing the Chasm. I highly recommend the book. That's a book is a must-read for any entrepreneur who are launching a new product. And what Jeffrey Moore called this gap is that you have to get it. Is that the chasm? There are over 600 green building certificates around the world, right? But we only know a handful of like a lead. And why we never heard about another 500? Because they never crossed the chasm, right? And why the chasm is so difficult to cross? Actually, 90% of the company fail at this part, and they couldn't cross the chasm. And why it's so hard to cross the chasm?
You first have to have a product market fit, and then next you have to have enough early adopters, and they can inform the non-adopters, and then do marketing and other strategies to get more people and customers in the ecosystem. So that initial energy is very important.
Yeah, that book is actually for the marketing executive. It is like extremely demanding for in terms of the capability of the marketing strategy, and that's why 90% of the startup fail at this chasm. And why it's so difficult is because of the dilemma that we talk about. Is like you can't really convince this early majority until you have enough data. But if you don't try, if you don't have enough early adopter, you won't have data, right? So that's a juggle that you have to tackle in your marketing strategy. Now, getting back to their game plan, they decided to target, as Juan mentioned, the important belief. You cannot change those people. It's very hard to change those people, right? To change people's belief is very hard. You can only find those who believe what you believe. So what do you think it tells about their leasing strategy? Bill, you mentioned the age. What else can inform? Who is your tenants? Like, who do you think is likely your tenants? You're talking about maybe is younger age, younger firm? Startup? But do you think they actually care? Because if I'm a startup, I'm struggling to raise money, making money, do you think I actually care to pay a premium to stay in Park Avenue? Wilson? How about the size of the company? I agree with you. So when you look at their floor plate, it's about 14,000 square feet. So imagine if you are 20 people law firm, are you going to care? Probably not, right? But who is going to care is probably going to, they probably aren't going to target this, 20 people smaller firm. They are going to look at a full whole plate sign up, and it's mostly likely in the finance industry. How about their leasing strategy? Like if they find their tenants, say Citadel actually end up being one of their anchor tenants. It's a hedge fund, fit the profile perfect well. Citadel, I think at the time probably needed 200,000 square feet. So the space they can actually grow into that seems a perfect space. Probably not for JP Morgan, because JP Morgan end up leasing 2 million because they are too big, right? They're very, very big. So Citadel seems to be a very like ideal size tenants for them. How do you who do you think will be their the leasing pitch? Who actually make the decision in an office lease from the tenant side?
I don't want to be obnoxious, but I don't understand the A0 part, which I think is actually important to understand, because Citadel does not pay for their rent. The LPs pay for the rent. So Citadel will go for the most expensive office, and it's the LPs that get a little bit annoyed about it.
That's right. Yeah, Citadel, this hedge fund, right? Those LP, they put tons of fees, exactly, right, on them. That's why they are willing to do that. And I'm sure.
I don't understand that A0.
What do you mean A0?
No, why A0?
Why didn't you pick that?
Because I'm an LP.
Oh, you're an LP, so.
I'm not a GP.
So you're not happy that your GP.
If I were a GP, I would have gone for A. I think all GPs would go for A.
That's interesting, but does
and
LP.
Building, that's why it's full.
But does actually LP, when you make decision which GP you go, do you go to their office? If they live in a fancy office, do they impress you as LP?
It's not up to us. We have to pay them whatever they ask us.
But you're not happy if they go to a more expensive because it's all your money.
Yes, I'm unhappy. That's very true. But we have a very unattractive office, but we're paying for a very fancy office for them. And it said, I think you mentioned John Hancock Building as one of the nicest buildings. They have the highest building. They have the top floor ArcLight Capital. I shouldn't say this, but beautiful office. We don't get anything out of it, but we have to pay. Yes, that's actually an interesting point. I was talking to one of the local PE firms. They went to a very fancy view, very impressive view building, and moving from a less impressive building. And I say, oh, why do you pay for that, right? It's probably like 20% lease rent premium. They say, because we want to impress our LP. It sounds ridiculous that the better view, in fact, the skill, your investment skill. I'll tell you what the reason is. It's because the LPs are paying for it, not them.
Yeah, the LP is paying for that, but then in order to get the LP, they need a granular office, healthy office to impress their LP.
No, I think it's because they are paying for it.
So who do you think is making the decision in Citadel or any financial institute? Is the leasing people? Do you think the leasing people care about those, payroll, care about those rent? or they may care about the utility, but do you think they care about health insurance? How about the split incentive within the tenants organization? Carlos, what do you think? You are in the negotiation, right, for the lease in the office section. Like if you were, into that and you are leasing, you are the facility. Usually they are facility people. They're probably older people, right? And when you do that, like, will that, if they show you this, do you think you will care? Yeah, as tenants.
I mean, taking into account that, for example, if I do come from some place that I do need to have a premium office space to attract new clients, I will most certainly go if it does not affect my revenue at all. But for example, as my background as family business company, we do not need premium space. It would not change our revenue at all. So we wouldn't even consider paying for a premium office space unless we have a foreign investor that has a green mandate that we have to spend X amount of our OPEX or do CAPEX investments in green buildings or green assets.
I agree with you. So if you are, say, a construction firm or say a law firm, right? Maybe it's less important than the LP and GP, right? So this is most likely actually going to be someone who has an LP.
Actually, the target tenants only like some famous and big name headquarters, and always the decision maker only based on the GP, and also the famous branding.
Yeah.
And you need famous influence to globally. So the target tenants only this.
Yeah. So in terms of time, I think Yeah. So in terms of the time, I think let's find out what happened with the case. You are right. I think in the leasing strategy, it's very important to engage who people care about the balance sheet, about the tenant's cost, which they are typically going to be your HR person and going to be your CFO, right? And how, when you're leasing, how do you engage those people beyond the facility real estate people? That's kind of something that you need to consider. And let's find out what happened. Can you open that? So what happened is that actually, because of when you look at adoption of the well, they started 2014, and 2016 is when they make the decision, right? So when you see this adoption, it has been accelerated because of indoor air quality, and for all the reason that Juan's lecturer has mentioned, that they were being massive market acceptance. And then the happy story is that they did break the record of the most expensive office lease in the NYC history, 300. Like the rumor is about close to 300 per square feet, but that's the penthouse level. Citadel originally signed a 200K. Again, if someone has the LP, and 300, and they later extended to 300, but they still have half of the building to fill. In 2020, the building is actually in financial distress. Unfortunately, the LP lost all their money. LP in this case is the Japanese money. The reason why is because 25% of the office structure has proved to be extremely difficult. So the project was delayed for over a year. That cost them $100 million. And that, I think BXP is trying to buy the deal from them, but then later Blackstone, I think, salvaged the project. But the equity was wiped out, unfortunately. But that's not something to do with the healthy building. It's just the risk of this project. And in the recent thing, and now let's get back to the final question: is this a successful decision? So in 2021, you see a lot of news in the current about the office sector. They are in a lot of distress, but there is a flight to quality trend apparently in the top tier office sector right now. And in one of the new data shows that in 5 US CBD, in the past 2 years, there's 7 million square feet of increase in the demand for the ultra healthy, ultra high quality building, while the demand in the lower quality building, which is usually cheaper, class B, is down by 25 million square feet. So there's a winner and a loser in this project, right? And again, we won't have time to discuss this, but I encourage you to think about, well, this building strategy working in a wider market, right? And finally, I want to wrap up about to this case is about the science and the performer, as well as if you go for that risky play, what is your strategy to engage your tenants and the market? That's all. Thank you.